You don't have to do that on FHA though. So a lot of stuff happening with conventional loans. They also put in loan level pricing hits. Basically what loan level pricing is, it means that the higher your credit score, the better your rate. The lower your credit score, the worse the rate. It used to be if you had a 620 credit score and 850 credit score, your rate would be the same. Now it's tiered in 20-point increments. To give you an example, somebody with a 680 credit score has an adjustment of 1.5% on an 80 LTV loan. That can mean the difference. That's not to the rate, it's to what they call the discount. But that could mean the difference between getting a 5% rate and a 5.5% rate. So it makes a big difference for somebody. This is only on conventional, remember that. On somebody with a 620 credit score, putting 20% down, there's a 3% hit at an 80 LTV from Fannie Mae. 3%. That can mean the difference between a 5% rate and a 6.25% rate. Or you might not even be able to buy out the 3%. You may have to bring the money to closing on it. You add an investment property hit to something like that, and it's like 5.5 points you have to pay to Fannie Mae before you can even do the loan. And a lot of times you can't even buy those out with the interest rate. So on some investment properties with people with lower scores, like 700 scores, that doesn't sound that low, but it is, we've had to charge borrowers like 1 plus 2.5 just to get the loan done at an 80 LTV. And it wasn't, we were not making maybe a point on the deal. All the money was going to Fannie Mae on it because of these credit score adjustments. So what does this mean? This means that those people are using FHA financing, another downward pressure to use FHA financing. Borrowers with lower scores are forced to use this. Let's talk about PMI. The PMI on a $200,000 loan with 5% down, $200,000 loan amount, 5%, 95 LTV, on a conventional loan is $159 a month. I'm going to show you an example here in a minute. On a FHA loan, it's only $91 a month. So there's another big difference too. The MI is a lot more expensive on a conventional loan than it is on a FHA loan. So how big is this buyer pool? Pretty nice buyer pool. It's still out there. People are still having fun in it. Let's talk about FHA. So here's the good news. This is where all the fun happens. Purchase price is up to $300,000 on FHA. USDA, it just really depends on their debt to income ratio. There's no maximum loan amount on USDA. However, you can have a maximum DTI is going to be 50% on those. 3.5% down payment on FHA, 5% on conventional, 20% on jumbo. 0 down for a USDA loan, 0 down for a VA loan. We're not going to talk a lot about VA today just because there's just not a lot of demand out there here in the Austin area for it. We have 4 or 5 of them a month. FHA also has that lower mortgage insurance like I was talking about a minute ago. $200,000 loan amount, it's $92 a month on FHA. What was it on the conventional? A lot higher than that? $159. Yeah, $159. So that's for some people that's a lot of money. On a USDA loan, it doesn't even have monthly mortgage insurance on it with a 0 down payment with a 620 credit score. So somebody getting a USDA loan at 5% today with no monthly mortgage insurance and 0 money down, that's like getting an equivalent rate around 4% because of the mortgage insurance. There's a reason why people, that's a big incentive to use these. There's no loan level pricing hits on FHA, VA, or USDA on a purchase. That means somebody with a 620 credit score and 850 credit score are going to get the same rate as somebody at the same rate as the other person. So if USDA is at 5% today, somebody with a 620 credit score and 850 credit score would get the 5%. Conventional, the 620 credit score person wouldn't even get the loan. Another downward pressure on it. This price range tends to have a majority of the first-time home buyers. I'm going to show you guys some numbers in a minute to show you how the market shifts there too. The Fed is buying Ginnie Mae securities to drive down interest rates. Those are the mortgage-backed securities that are backed by FHA loans. The Fed's buying those also, not as much, but they're keeping them about the same rates as we are on conventional loans. Rental rates, we talked about rental rates a few minutes ago. Remember, rental rates are about comparable, especially I've run some numbers in Pflugerville, 3-bedroom, 2-bath houses over there. You can pick up a $150,000, $60,000 house over there with a payment of around $1,200 on a USDA loan, with taxes and insurance and everything included on it, with no money out of pocket. What does a 3-bedroom, 2-bath house rent for in Pflugerville? Anybody? About $1,200 a month. Okay. So those are a big incentive for those people to go out and buy that price range of house. Debt to income ratio on FHA, VA, and we're almost 100% sure on USDA moving forward that they're going to allow up to 50% back-end ratio, that DTI. Remember, conventional is at 45, and if you have to have mortgage insurance, it's at 41. So there's a lot more people able to qualify for the FHA and the USDA loans out there.
You can't do USDA in Austin.
You cannot. You cannot. But there's a lot of places around Austin that you can. Eastern Pflugerville, Northern Leander, all of Hays County except for San Marcos, Hutto, Manor, anything north of 1431. And that's why I think you see a lot of people buying in those areas too. The last downturn I remember here in town, Pflugerville took it in the you-know-what because there was nobody buying in Pflugerville. And right now they're sitting at less than 3 months worth of inventory. The reason being is because Eastern Pflugerville qualifies for USDA financing. The price point's cheaper. There's a lot of first-time home buyers out there. That's where people are buying. That's where my loan officers and I are spending our money right now to generate leads for buyers, is in that market. We're not going after the jumbo loans right now. A couple changes that all happen. FHA is implementing their own type of HVCC. So we're going to have to start using third-party appraisers on FHA loans. We'll see how that goes. In months of inventory in this area, 1 to 5 months. I looked up in Wells Branch probably about 30 days ago. It had 1 month's worth of inventory in Wells Branch. That's a super hot market. And I'm sure you guys have buyers go, well, let's offer them $20,000 less than what they're selling the house for. It's been on the market 1 day. Okay, what does that buyer pool look like? FHA. That's a pretty big pool. Thought y'all'd laugh more about my pools, but I don't guess they translate as well. I was in front of my computer last night going, oh, this is funny. Okay, so let's look at that supply and demand. Price range of $439K and up. We have 9.25 months worth of inventory. It's this number right here. That's average around town. That's as of this morning inside the city limits of Austin and pending sales. I use actives and pendings. I don't use closed. 299 to 439 is 4.39. It says in the city limits of Austin. And then below 300 is 3.21 months worth of inventory. That's as of this morning. I also went in Pflugerville and saw it was 2.9 months worth of inventory. That's as of today. And remember, I think that a lot of our transactions that would have happened this month and would have happened next month were stolen by November. Y'all know what I mean by that? Stolen because people wanted to close on the first-time home buyer tax credit, and they didn't know if it was going to be extended or not. You know, I had this horrible thought at the beginning of November before they extended it. I can just imagine Bubba out in my parking lot of my office building with his U-Haul the day after on December 1st going, why didn't I fund? Where's my $8,000? And not only does he have his U-Haul, he has a shotgun too. So luckily that didn't happen. They extended it. We all moved forward. And they extended it in some good ways that we're going to talk about too. But as I was saying, I still think they stole everything from the future. Okay. In my office in 2008, this is what our mix was in 2008. 45% of our loans were conventional, 10% were USDA, 30% were FHA or VA, and 15% was jumbo. How do you think that's going to compare to 2009? 0 jumbo loans. We didn't do a single one last year in 2009, not one. And we do a lot of business in my office. I think it has to do with our marketing. Conventional went to 15% of our business. USDA went from 10 to 42% of our business, and last month it was the majority of our business. FHA and VA went to 43% of our business. So these two alone account for almost, 85% of our business? That's where those buyers are. Here's another interesting deal. I looked and said, okay, in 2008, how many first-time home buyers did we have? 46% of our buyers in 2008 were first-time home buyers. 54 were existing. 2009, where do you think the home buyers are now? They're first-time home buyers. They're being incentivized by the federal government to go out and do and buy houses and spend money. Existing homeowners are sitting pat. They may switch a little bit now that they get a little bit of money too. But this is a big-time number. Last month, I think we're at 90% first-time home buyers. That's for the whole year so far. So as you can see, the market has definitely shifted from 2008 to 2009. Remember, we're looking at the past right now to figure out what's going to happen next year. So we can tell that these incentives that the federal government's using, they're working. They're buying mortgage-backed securities. They're giving you first-time homebuyer tax credit and existing homebuyer tax credit out there. Their rental rates, the organic stuff, also working out there, but jobs haven't come back yet. So we're seeing the incentives work in the lower price ranges where financing is easy. If you can get the financing, the demand's there.